My husband and I are retired, ages 69 and 62, and we're both drawing Social Security. We have approximately 450,000 in our IRA. We already have one fixed index annuity for 100,000, and we're needing to supplement our monthly income from Social Security, a small pension, and annuity payment. We are considering a $200,000 Allianz fixed index annuity with a guaranteed minimum payment, but it has fees of 2%, around 2%, and the surrender fees are very high. So what other secure types of investments would you recommend to provide some type of guaranteed stream of income?
Well, I would do the income portfolio where you get about a 4.5% to 5% income. That could be going up as inflation goes up here soon. But I mean, I think that's a pretty reasonable rate of return that you can get. And what you might want to do is open up an investment account and start looking at those investments from the income portfolio. Start thinking about putting some of that money into some good, solid utility stocks and some industrial kinds of stocks as well to secure some income. Now, if you have no risk tolerance and you don't want to do that, then the only other thing you can do is a charitable gift annuity, or I'd never recommend commercial annuities. I don't like them. But remember, your annuities, your commercial annuities, are not exempt from losses. I know you might think they are, and they use the word guarantee all the time. But I would ask them that question and say, so the worst case scenario is I make 1.5%. Am I going to get that 1.5% compounded on my principal every year, no matter what happens? Or is my principal going to, meaning my principal can only go up by 1.5%? And is that going to be the case? And you need to ask that question like that. And you need to ask them, if it is a guarantee, for them to put it in writing. And they should gladly do that for you, or the company, Allianz, should be glad to do that for you. Because there is no rule, though they may tell you this, that they can't put it in writing. They can put it in writing if it's a guarantee. They're perfectly able to do that. Both the National Insurance Commission and the state insurance commissions don't have a problem putting anything that is a guarantee in writing. So when you look that it's indexed next to a S&P 500, well, so that means if the S&P 500 is up 22%, you should be up 22%. You'll be up maybe 4%.
Because of your cap.
Yeah. So if you want to be indexed, if you want to do what the S&P 500 is doing, then go directly to the S&P 500 and invest in it, or one that is a mutual fund that is going along with that. So when it's up 22%, you'll know you're up 22%. Otherwise, it's not even close. And these are some of the reasons why I don't like these products. They're not what they appear to be. And yes, the fees are 2%, and I wonder if that's all of the fee, because I would suspect that does it have a death benefit? It probably.
And it has a long-term insurance care rider too.
Yeah, so the fees are going to be way more than that. Way more than that. I can guarantee you. And as you get older, the mortality fee on both those things you just mentioned is going to go up as you get older. It's just not what they say it's going to be, or what they develop as your perception of what it is.
Another thing to consider too is that equities are a hedge to inflation. So if we see inflation going up a whole lot, you have to make sure that in that product you're able to follow up the index as far as it goes. You have to ask what the cap is, what's the participation rate, how are they calculating the index? Is it point to point? Is it average? I mean, there's probably five to 10 different ways that they can calculate it. It's not just a simple, if the market's up, then your product is up.
Some only calculate the dividend, just the dividend alone on what it's indexed to, that those stocks in the S&P 500 include. So it's so many things. We could glaze you over with all that, but I go back to one great question is it all guaranteed, my principal? So they get us thinking about it like a CD. Okay, I put $10,000 in a bank. They tell me I'm going to get 1%. I'm going to get 1% on my 10,000. The following year, I'm going to get 1% on my 10,000 plus my new principal, which is 10,000 plus the 1% I got last year, and then so on and so forth. And that's going to continue. That's how our minds think, because we're conditioned like banks would have conditioned us over the years about CDs. So I would be careful. I would tell you to think about it, but I know you had a comment or a question there. Go ahead.
I was just going to say it is point to point, and it's tied to you have an option of certain fixed index annuities that they have chosen. But I'd like to go back to your recommendation about the income portfolio. So my concern there is, my understanding is that you invest in certain stock and take the dividend. But
correct.
When the dividend ends, you recommend selling. But chances are that stock could be down, so you could conceivably go broke, couldn't you, after a period of selling and it being down?
Well, if that happened every 3 or 4 months, yes. It's dividend paying stocks that are on my list. Most of them have been paying their dividend for 20, 30 years. They're dividend producers. They exist to pay dividends. Very rare that they cut dividends. Over a very bad time like the pandemic, a lot of companies cut their dividend. I would say a third of those companies have restored it back already. So it is not likely, but understand this. Stocks don't go necessarily down when the dividend gets cut. Stocks are generally going up when they cut the dividend because the board says, why are we paying a dividend? We're up 42% and we're paying a dividend. Who cares about a dividend? We're up 42%. When stocks are going down, the last thing they want to do is cut their dividend because they're trying to stop the bleeding. In other words, their stocks are going down because people are selling. They don't want to exacerbate the selling by cutting their dividend. That's the last thing they want to do. So you need to have a kind of a direct opposite of how you're thinking about that. So the other thing is, you should never, and this may be you, and this is what I was talking about, you might be very risk averse. If you are truly a dividend producer, so let me just give you an example. Suppose you need to generate $200 a month, and you say, I'm going to take whatever it takes me at 5% to generate $200 a month. You do that, it's invested to make the $200 a month. The idea is a true income investor, that all you care about is the income, that you're not getting excited when this, like right now that's happening with all of my partners, driving me crazy about the utility stocks because they're up so high. And they're saying, well, I want to buy, I'm up 40%. And I keep saying, that doesn't happen. It's not supposed to happen. Utility stocks aren't supposed to be up like they're up right now. So don't get excited. You're in it for the income. Just stick to the income. And I would say the same thing on the downside. When they go down, you're in it for the income. Just stick to the shares. You're not, your dividend's not going down. Your stock's going down, and it will come back up again. And in the meantime, you're getting paid to wait for it to come back up. So you have to have that mindset, because if you don't, you're going to be a very unhappy income investor for no apparent reason. The only reason you're going to be unhappy is for something that is happening in the short term, not something that is a systemic risk or a systemic problem that is going to continue for the rest of your lifespan of that stock that you own.
Hey, remember to click the subscribe button right here on the screen. And don't forget to hit the notification bell so you'll be notified when new content is added. And more importantly than anything, you don't want to miss all 3 live hours of Financial Issues every day from 9 to noon. And you can watch it on FISM.tv. That's FISM.tv.